Assalamu alaikum, this is Fahad Ali with you again. This time the video is all about depreciation past. If you haven't subscribed then do subscribe channel, and let's start with the video because there are many videos coming for the past papers in the future time period for different topics, which could be from economics, which could be from business studies, and which could be from accounting. So let's start with the first past paper. This is a question paper which is of O levels, May June 2015, and the variant is 22, which is commonly used in Pakistan. So we are starting with this 2 hours paper. The syllabus code has changed if you are watching this video in 2023 and onwards. So the syllabus code has become 7707 for accounting, and the name has also changed from principles of accounts to accounting. So we can see that we have question number 1, which is books of parliamentary. I have my own video of books of parliamentary on this channel. So if you haven't watched that, you could just look for that video in the uh, on the playlist. And this is question number 2, which we have to focus on in this video. So there are certain things I will just discuss before we can proceed forward for the question to be simplified. There are 3 things we'll be looking forward in a depreciation question. First thing, which is very important, is the dates. So there should be the dates which are important. We need to focus on that. Then the depreciation method. There are 3 methods. I hope you have watched the video of depreciation, because we need to watch the initial video, which is the introduction video. After, you will be able to solve the questions. And the last one is depreciation policy. So we need to look for these 3 things in a depreciation question. First is the dates. Dates mean the financial year, where it starts and where it ends. Depreciation methods. There are 3 methods of depreciation. I've already taught you this thing in a video, which is straight line. So I'll just write it down over here, straight line method. And then we have a reducing balance method, which is RBM sometimes called, which is diminishing balance method. So there are several names which is used by the examiner. So reducing balance method, diminishing balance method, these all are same. So the last one is revaluation method. So I hope you would have observed this in the video on my channel. So coming back to the depreciation policies, there are 3 policies. I'm giving you a quick recap. Depreciation in the year of purchase, but no depreciation. I just need to move forward. No depreciation in the year of sale. Okay, this is the first policy. The second policy is the opposite. Depreciation should be charged in the year of sale. We don't use the word sale because non-current assets are not sold, they are disposed of. So we could write down disposal. Okay, in the year of disposal, but no depreciation in the year of purchase. So this is another policy. The policy is given by the question. Every question will tell you what to do. So just look for the policy in the question. No depreciation in the year of purchase. This is second policy. And the last one is pro rata basis, where the question will give you the signal, will give you the hint that you have to charge the depreciation for number of months owed. Okay, I'm writing it down in a short form, number of months owed. So these are very important things we have to look for. The dates will be given in the question. Dates means financial year. And the second is the depreciation method, and the third is the depreciation policy. Whether it's first policy, second, or third one, we need to look for that. So now let's move forward to the question, because the prerequisites of the question has already been discussed with you in this video. So let's move forward to the question. Now this is the question where it is saying Auto Electrical had the following non-current assets on 31st March 2013. So I've got the year. So 31st March 2013. 31st March 2013. So this year would be starting at March, April. So the year would be starting from April 1st, 2012. Okay. So I'll just write it down again, because I guess I messed it up over here. So April 1st, 2012. I hope you've already studied this thing, that these should be 12 months. So 12 months are there. So the year starts every year at April 1st. And then it ends in 31st March 2013, whatever the year is, but the year is starting in April. So let's move forward. We have the net book values, we have the cost of the assets. So the cost of the asset is given, the net book values are given. What is the difference between the net book value and the cost? I'll repeat again. The net book value is the value we receive after deduction of depreciation. How do we get the net book value? We get the net book value cost minus depreciation, we get the net book value. How do we got the cost? The cost is the cost at which the asset was purchased a long time ago. So that is the historical cost. That is the cost which at which the asset was bought. Let's suppose 5 years back, 4 years back, or 7 years back. It all depends on the question. So cost is 50,000, whereas the depreciation, whereas sorry, the net book value is 48,000. So it means 2,000. The difference between the cost and the net book value is 2,000 is the depreciation on this particular asset, which is premises. Motor vehicles, again, cost is 16,000 and net book value is 12,000. So it means the 4,000 difference between both of these things is the depreciation which has been charged already. Computers, there is no cost given in the question. There is directly given the net book value, which is useful for all of us. The second thing which you have to see in a question is the depreciation method. So for premises, depreciation at the rate of 2% per annum by reducing balance method. So let's write it down over here. For the depreciation method, I'll be just writing it down over here, that depreciation for premises is for straight line method. Okay. So for premises, we have a straight line method, which is 2% per annum. And then we look for the next asset, which is motor vehicle. Motor vehicle, it is saying motor vehicles are depreciated at the rate of 25% per annum by reducing balance method. So I'll write it down over here. Motor vehicles. Okay, I need to adjust my tablet. Motor vehicles, so it is reducing balance method RBM, which is percentage, I guess, is 25%. Okay, so it is 25%. And then we have another thing, which is computers, which is saying computers are depreciated by revaluation method. So I'll just write it down over here. Sorry, I forgot to write it down with a pen. Computers are depreciated with revaluation method. Okay. Revaluation method, we don't need any percentage at all. So that's why no percentage given in the question. So let's move forward. A full year's depreciation is charged on all non-current assets owned at the end of the financial year. It means that at the end of the financial year, that means this policy is being used, which is the first policy. The depreciation in the year of purchase, but no depreciation in the year of sale, in the year of disposal. If before the end of the year you have sold the asset on any particular date, so you will not be charging your depreciation. This is first policy. We need to remember this thing. Okay. So whenever there is a policy third pro rata, so it is number of months owned. Maybe the asset is owned 6 months. So what do? You do 6 by 12. If the asset is owned for 3 months, 3 by 12. Why 3 by 12? Because 3 months out of 12 you multiply it with the depreciation, which is annual always. So you multiply it will be 3 months depreciation. But we'll look into that afterwards when we have a question for that. So let's move forward for the requirement number 1. So far we have got the details. Additional information is saying there was no purchase or sales of non-current asset during the year ended 31st March 2014. Sorry, correct. Second one is saying the following purchase of non-current assets were made during the year ended 31st March 2015. The payments were made by check. Okay. In the first year, in which we have to do the accounting, we haven't purchased anything or we haven't sold anything, because the first point is saying this thing. The second point is saying in the second year, that is in the year which ended at 31st March 2015, we purchased some non-current assets by check. And the third point is saying computers were valued as follows. So we'll just go for the reducing balance method. Explain the term depreciation. I'll ask you to write down the definition. I'll just dictate it very slowly. It is the spreading up of the cost of an asset. It is the spreading up of the cost of an asset over its estimated useful life. I'll repeat again. It is the spreading up of the cost of an asset over its estimated useful life. So this is the first definition, which will give you 2 marks. Second is state one cause of depreciation of a computer. So it could be technological advancement, it could be obsolescence, it could be wear and tear. So there are many reasons. You could write any one from that. So you'll get 1 mark. Moving forward, the main requirement, which is of 6 marks, complete the table to show the depreciation to be charged to the income statement for each of the years ended 31st March 2014 and 31st March 2015. So let's do that together, and we'll be solving this in the whiteboard. Okay. So if I make this table, if I try to make this, okay, I guess my drawing is not that good, but again, I'll try my level best. If we could just do the things. Okay. Okay. So I'll just make a big table, which will be over here. We have to just say year ended 31st March, year ended 31st March 2014. Then we have this much, which is year ended 31st March 2015. So this is March. I'll just write it down again. On the left hand side, if you see, we have the table which is called premises, motor vehicle, and premises, motor vehicle, and we have got computer. Okay. So far, I have been successful in making the table in an appropriate manner to some extent. So I hope it's understandable for all of you. You could understand this. So for the premises part, the depreciation is saying, which is, you could see over here, this one, straight line method, which is 2% on cost. So the cost of premises in first year is 50,000. Okay. How did I get that value? If you see that the cost of premises is over here, which is saying cost 50,000. So I picked this cost and I just multiply this 50,000 into 2%, which will give me an answer. I just need to use my calculator. So 50,000 multiplied by 0.02, which is 2%, which will give me the depreciation of 1,000. This is my depreciation. Okay. Whenever there is straight line method, always multiply the cost with the depreciation rate. So this is the formula, cost into depreciation percentage. Okay. So I hope I have told you this formula. Where you don't have the estimated useful life, how do you calculate the depreciation? You calculate it by cost minus scrap multiplied by percentage. This is the formula which is for straight line method, SLM. Okay. So cost minus scrap is 0 if it is not given in the question. So cost into percentage of depreciation, which is given in the question. So you multiply it, you got an answer of 1,000. And for the second year, let's see whether did we purchase any premises or not. We purchased one premises, which is 30,000. So what do we do? In the second year, we will have depreciation in this, like this. Premises, earlier they were 50,000 given in the question. Now this year we purchased premises of 30,000 more. So 80,000 will be the answer. So 80,000 becomes the cost of the premises. Then you multiply it by 2%, which is depreciation. So let's see what is the depreciation in this year. So 80,000 multiplied by 0.02, which will give me an answer of 1,600. So this year the depreciation has increased to 1,600. Okay. So I'll write it down 1,600 over here. I hope you understood this thing. These two things have already been done. So motor vehicle is something which students do find it difficult. So let's do motor vehicles. Motor vehicles depreciation is calculated by reducing balance method, which is 25% if I'm not wrong. Okay. So whenever there is a depreciation charged by reducing balance method, we always charge depreciation on net book value. How do we find the net book value? We find the net book value by doing cost minus depreciation, which is already given in the question. There will be some depreciation given in the question. Sir, what if this is the first year of the question? If the question is saying the business has commenced just now. So if the business is saying the business has commenced just now, so the depreciation will become 0 in that particular scenario. But if the business is old enough and there have been assets with the business for a longer period of time, so you will not say it is 0. So you'll write down cost, you will depreciate it, you will minus the earlier depreciation already given in the question. Then whatever answer comes, that will be the net book value. But as you see that in the question, sometimes there is a new asset which has been purchased just now. So for a new asset, there will not be any depreciation present in the books. So you will do cost minus 0 because there won't be any depreciation. So your cost would become the net book value in that particular scenario. So let's do it for this asset. We need a net book value for motor vehicles. So we have 12,000, which is already given in the question. So question has made it easy for us that the question has already given us 12,000, which is the net book value. This point is saying there was no purchase or sale of non-current asset during the year ended 31st March 2014. So this is the simplest thing we have to do. So we have got the net book value, which is 12,000. Sir, how do you get 12,000? The 12,000 value is already given in the question. Multiply it by depreciation percentage, which is 25%. I'll get the answer depreciation, which is 12,000 multiplied by 0.25, which will give me the answer of 3,000. So my depreciation for the first year is 3,000 for motor vehicles. How did I get this? 12,000 is the net book value already given by the question. So I just multiply the rate with the net book value, because in reducing balance method, we always multiply the rate with the net book value. So 12,000 is the net book value of motor vehicles. I multiplied 25%. So I got 3,000. Okay. So now see for the second year, what is the depreciation? In the second year, you purchase the motor vehicle of 9,000. Okay. So you have to do it separately. Sir, the first motor vehicle which was there with us from the last year was the net book value of that motor vehicle was 12,000. And in the last year, we charged some depreciation. In 2014, we charged some depreciation, which is this depreciation 3,000. So now the new net book value of this asset in 2015 would be 9,000. So on this 9,000, we have to apply the depreciation percentage. Sir, why we have to get the net book value of this asset? We have to get the net book value of this asset because reducing balance method always applies depreciation on the net book value. So how did I get this net book value? 12,000 was given in the question. In 2015, I have to deduct the earlier depreciation. Okay. The last year's depreciation. This is the net book value for 2015. So in order to get the net book value for 2015, I deducted the earlier depreciation which I calculated last year. So 12,000 minus 3,000, I got the new net book value for 2015. So I multiplied the depreciation rate. So multiply it by 25%. This will be the depreciation rate for this year, 0.25. So which is giving me 2250, the depreciation for 2015, year ended 2015. Okay. Sir, there was another motor vehicle which was purchased. So for that particular motor vehicle, the amount was 9,000. So this is another motor vehicle. So this motor vehicle, if we write it down over here, motor vehicle net book value. So the cost of motor vehicle is 9,000. Since this is a new motor vehicle which you have purchased just now, so if we write down less depreciation, so there hasn't been any depreciation of this motor vehicle because this is a new motor vehicle. So 9,000 becomes the net book value. If you multiply this net book value with the depreciation rate, which is 25%, so I get an answer of 2250 again. This is old motor vehicle. This is new motor vehicle. So depreciation is, what is the total depreciation, which is 2250 plus 2250. So the total depreciation for 2015 will be this one. Sir, why have we charged the depreciation on the previous machine? Because the previous machine has not been sold so far. The question hasn't mentioned this thing so far that the previous machine has been sold. If the question would have mentioned that the previous machine was sold, so we couldn't have calculated the depreciation on that particular asset. Okay. So now for the computer thing, we have to go for revaluation method. For 2014, always go for net book value in computer. So we already have the net book value, balance BD. So we take the net book value of balance BD. So we have the balance BD with us, which is given in the question. There is only one balance, which is 6,000. So according to us, the machines should be, there was no purchase or sale of anything at all. So I don't have to add anything. I don't have to deduct anything. So I write down 6,000. And in the end of the year, this becomes the balance CD, which is 4,200. If I did not purchase anything, if I did not sell anything, so the difference would only be the depreciation, which is 1,800 if I'm not wrong. Okay. Sir, how did you do this? If I go for the full-fledged format of revaluation, add additions, balance BD, add additions, less disposals, and balance CD, which is calculated. That is the balance CD which should be there according to you. So this balance CD is deducted from the balance CD, which is less balance CD, which is given in the question. So you just take out the difference, but this time this is 0, this is 0, this is 6,000, this is 6,000, and this which is given in the question is 4,200. So the only difference due to which the computers would have decreased is 1,800. So this is for 2014. Okay. So for 2014, I write down 1,800 over here. 2015, I would have to do one thing. We have to start from the scratch. So 2015, this balance CD would become balance BD for the next year. So balance BD would be $4,200. And is there any computers purchase? Yes, there has been computers purchase, which is 3,200. Okay. So I just write it down 3,200. Add additions 3,200. So this will give me an answer of 7,400. According to me, the computers should be valued at 7,400. Balance CD, which is calculated. Okay. So I just deduct the balance CD, which is given in the question. So I get the difference is always the depreciation, which is 6,000. How did I get 6,000? This is given in the question. 4,200 was already given. Okay. So I just deduct 6,000. So I'll get 1,400, which is the depreciation. Okay. I hope you understood this question. If you did not understood, then you can just go back and just learn all the instructions. So this is 1,400. Okay. So we have solved the third part, I guess. Okay. So we have to make D, which we have to make the motor vehicles T account, and we have to make the motor vehicles provision for depreciation account, which is very easy. So let's come back. Sorry, I did this. So we have to make the motor vehicles T account. Whenever the question is not saying anything, we have to make the cost T account. Okay. Okay. So it is 2014 because the year is starting in 14. So let's start with the first date, which is May 1st. Balance BD, and the balance BD of the motor vehicle is given in the question, which is like this. Cost 16,000. Always take the cost. Okay. So 16,000. Then you purchase some motor vehicles. No, you did not purchase any motor vehicle in 2014. So what do you do? In 2014, you did not purchase any motor vehicle. So this motor vehicle will become balance CD as it is, which is 16,000. So just close this down. And in 2014, okay. Sorry, this was 2013. I just messed it up. So the year was starting in 2013. It ended in 2014. So in 2014, the year is starting on May 1st. So on May 1st, you would have the balance BD, which is 16,000. Always take the cost because this is cost T account. Okay. 2014, we purchased some motor vehicles in this year. And what is the date for that? The date for that is March 31st. We have purchased it by check, so we'll write bank and 9,000. Okay. Now, some students would be confused by this thing, sir. Why we are taking this amount? There is no cost on net book value. Whenever the asset is purchased, the net book value and the cost of that particular asset is always same. Okay. So remember this thing. So 16,000 plus 9,000 will give me an answer of 25,000. Sorry for balance BD, it's balance CD. Okay. This is balance CD. So the account will close down over here like this. The next year we have to write down balance BD because balance BD carries 1 mark. Sorry, I don't know what I'm doing. May 1st. Okay. So balance BD becomes 25,000. Now there is another requirement of provision for depreciation T account. So let's make the provision for depreciation for motor vehicles. This is the last requirement for you people. If there is any question still you don't understand, so just ask me that in the comment below. Provision for depreciation. I hope you would have subscribed the channel because so far I'm working very hard for the video. So this is 2013, the first year. That is, sir, how do you get the depreciation? Motor vehicles cost is 16,000 and the net book value is 12,000. So the 4,000 difference is the depreciation. Okay. The 4,000 balance BD, the 4,000 amount is the depreciation. How did you find it? Net book value, how it is calculated, cost minus depreciation. Okay. So net book value is equal to cost minus depreciation. If you don't know the depreciation, you have the cost, you have the net book value. So again, you could just rearrange the equation and you will get an answer. So April 30th, this depreciation becomes, this depreciation, more depreciation will be charged on April 30th with the name of income statement. From where we will write it down? We'll write it down from the table we have already prepared. That makes it easier for us to just copy down this thing. So the motor vehicles depreciation for year ended 31st March 2014 was 3,000. Okay. So I'll just write down 3,000 as income statement. So the balance CD part would become 7,000 for motor vehicles. So I'll just close the T account. And in 2014, the year will start again on May 1st. We have balance BD, which is again 7,000. Then we have April 30th, again the income statement, which is the depreciation we have already calculated. So the depreciation will be from the table. Let's see how much depreciation did we calculate earlier. It is 4,500. Okay. 4,500 of this question. So 4,500. Okay. So I'll just close the T account. April 30th, balance CD, which is 11,500. So just closing the T account, writing both the names over here. 2015 May 1st, the balance CD will become balance BD, and there is 1 mark for balance BD. So always write it down. Okay. Now let's see what are we left with. What we are left with. Okay. Done with this. Identify two of the following accounting principles support the charging of depreciation. The two accounting principles which support the charging of depreciation is matching concept. Okay. So matching concept is very important, and we have to see this thing that whether we have to go for this or not. And then the second concept which is very important is going concern. Okay. So we have to just go for this, and we have to record the depreciation. I hope you watched the video. If there is any question at all, if you want to ask, you can comment below, to subscribe the channel and share this video with those who want to watch or learn depreciation from here. And signing it off, inshallah, I'll be meeting you again in the next video. Allah Hafiz. Take care.